In 1908, months after the Panic of 1907, Paul Warburg stopped arguing in the abstract and did something bolder. He wrote out a suggestion for a bill. He called it a modified central bank of issue. Think of it as his practical blueprint for an American lender of last resort that could steady interest rates, protect gold, and keep panics from ricocheting through the country. This episode walks through that blueprint, what the institution would be, what it could do, and why those choices matter. So, Warburg's core lesson is simple. Stability comes from organized reserves in a functioning discount market, not from spraying out ad hoc, quote, emergency currency. Build a central institution that 1. Concentrates reserves, 2. Stands ready to rediscount short, self-liquidating commercial paper, and 3. Works through banks, not around them. Give it clear governance to keep politics and speculation at bay. Do that, and the whole system gets an elastic, rules-based safety net. First, context. When Warburg's essays were reprinted in 1930, editors added the April 1908 paper, A Modified Central Bank of Issue, the very blueprint we're using today, because it had been omitted from the earlier collected volumes. That tells you how central he considered the proposal to his reform program. What would this central bank look like? In Warburg's draft statute, the Central Bank of Issue of the United States, he would be governed by a 41-member General Council. 12 seats went to stockholder-elected members. Key federal finance officials, for example, the Secretary of the Treasury of the United States, and the Comptroller of the Currency, sat as ex officio members, joined by the chair of each of the 20 regional bank district associations. Congress itself would designate 6 members, 3 from the Senate, 3 from the House. The council would elect a governor and deputies and set policy within the law's limits. The design tries to blend the public oversight, geographic representation, and banker expertise while fencing off conflicts. For example, strict limits on officers outside investments. If that governance reads deliberate, so do the tools. In a closely related 1907 article that foreshadows the bill's text, Warburg sketches a Washington, quote, government bank with paid-in capital from both government and national banks, authority to issue legal tender notes up to prudential limits, and a mandate to transact chiefly with clearinghouses and their member banks. It would place Treasury funds, lend against high-grade collateral with conservative haircuts, for example, U.S. bonds at 90%, municipal at 80%, railroad at 60%, and, crucially, advance against clearinghouse certificates. The point wasn't to fuel speculation, it was to get safe liquidity where it belonged, fast. When Warburg connects this machinery to the heartbeat of modern central banking, rediscounting real bills, he wanted the institution to purchase 3-month dollar paper with at least 3 good signatures on them. One of them a bank acceptance or endorsement to encourage an American market in first class 2-name or more commercial paper. That turns immobilized single-name promissory notes into liquid assets you can sell at a known rate, exactly the European practice he admired. He also, using the new bank as the clearinghouse for clearinghouses, today's clearinghouse certificates mostly let banks dip into reserves without adding currency. Under Warburg's plan, they could be the pipe through which additional currency flows when needed, easing intercity settlement frictions during stress. Again, the point is elastic liquidity with discipline. When conditions tighten, banks rediscount short bills and in extremes, longer ones at published rates that guide the market. Why this architecture? Because as Warburg's contemporary Edwin Seligman emphasized, The real breakthroughs were 1. Shifting the focus from currency to the reserve problem, and 2. Adopting a true discount policy so banks could turn sound paper into cash on demand. Without combining scattered reserves and creating a rediscount mechanism, American banks either locked funds in illiquid assets or chased call loans on Wall Street behavior that amplified booms and busts. Warburg's plans attacked those root causes, and the philosophy behind it is consistent across his writings. Keep politics out of day-to-day credit allocation, deal with the banks only, and make member bank balances with the central institution count as reserves, so the safety net is both strong and simple to use. Warburg's modified central bank of issue isn't a relic. It's the through line to what became the Federal Reserve: concentrated reserves, a real bill discount window, and a neutral, rules-based backstop that works through the banking system. The design choices, governance, acceptances, clearinghouse links weren't decorative. They were the levers he believed would turn crises into manageable liquidity squeezes, not nationwide shutdowns.